One of the points of difference I find between myself and others in this field is around the notion of being invested all the time. I find that to be an indefensible idea. I don't see any evidence for it in any way, shape or form. I believe that investment is very, very much a notion of right place, right time, right market. And the most important part of this little triad here is right market. Being in the right market grants you an edge over and above any stock or instrument selection skill you might actually think you have. It is the market that drives the returns you get from any instrument. The unfortunate thing is that many people regard instrument selection as a treasure hunt. And unfortunately, I have a lot of personal experience with this because this is the way stock analysts, when I was involved in broking, would approach the market. They would turn up to our morning meetings to pitch their stock idea. And when I would call the stock up on what were then our very primitive dealing systems, it would have no turnover. And the point I would always ask them was, well, if it has no turnover and no one else is interested, why should we or anyone else be interested in it? And this would generally be met with a bunch of fundamental gibberish trying to justify this point of view. They viewed share selection as a treasure hunt, that they would find this golden egg that no one else had ever noticed, and then in the fullness of time, their geniusness would be recognised by the market and the price of this instrument would skyrocket. That unfortunately never happened, because the gross movement in an instrument is dependent upon the sector it is in. Classic case in point at present, if we're talking about equities, has been rare earths for the past 15 months or so. It is the segment that is driving the shares, not the shares themselves. They're simply being buoyed along by the sort of enthusiasm for the sector itself. But what I want to do is to apply this notion to the notion of commodities. Commodities are different because they present us with this very, very mixed bag of instruments that don't actually share much of a relationship. What I've done here is I've looked at what you consider to be probably the most popular commodities contracts that are traded on a daily basis. You'll notice there's two colour schemes. Oh, and by the way, this is the 52-week return. So back to the two colour schemes. There is blue and there is light green. Light green represents what we would sort of very broadly call agricultural commodities. These are in part the things that have been driving fears of inflation. You'll notice that in terms of positive return, and the positive return are those commodities to the left of the chart, they are dominating this particular return segment. They have been very, 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 very good trading vehicles for the past 2 years. Now you'll note I said the past 2 years because commodities have only recently, post, by and large, the Russian invasion of Ukraine, come into people's sort of field of view. But if we look at a segment within this, the grains, we see something very interesting. For the vast majority of these, their trends began in 2020. So this market has some longevity, it has legs under it. It is not a flash in the pan that has occurred just now. And this is an important point I need to make. Just because you have spotted a market now does not mean it did not exist last year. I understand that when traders look at daily charts like these, they think this is the only price information that exists. And that's not true. As we've seen, this is the longer term history of these particular instruments. So when you look at this, you're actually seeing a very narrow snapshot. And these prices, they only have relevance with reference to what has gone before. Every bit of price data is relevant to what is occurring to you. And if we look at softs, which is another sort of broad segment within this very, very broad universe of agricultural commodities, we see the moves began in 2020. They haven't begun in February 2022. So again, we have markets that have some longevity. So that when we look at soft commodities using daily charts, we see it's not as brilliant a picture as we think. We have cotton, orange juice, sugar drifting off. Lumber has bounced. Coffee has caught between a range between just under 240 and above 210. Part of the issue for these coming into sort of the field of view of people at present has been, of course, the Russian invasion of Ukraine. And much of the talk has been around the agricultural commodities that Ukraine produces, particularly wheat. It is often said that Ukraine is sort of the breadbasket of the world. And that's a wonderfully sort of broad, enthusiastic statement that carries with it a profound degree of hyperbole. But on this weekly chart of wheat, you'll see something interesting. The purple arrow denotes the timing of the Russian invasion of Ukraine. But you'll see that wheat has gone sideways for almost three and a half years. It then began to climb in late 2020, not 2022. It consolidated again for part of 21, then took off again. But the drift has been upward. That's an upward trending channel. And you can see that by the time the Russian invasion of Ukraine took off, wheat had gained 33% from that channel. The reasoning for that will become apparent in a minute. But what I want to do is I want to talk about having an archetype or a notion of how you look at commodities. My belief is that price action for all instruments is the same. It does not alter for any instrument. If someone comes up to you and says, you need a special trading system to trade instrument ABC, tell them to piss off because they're a dickhead. They've clearly never looked at a chart, or they're trying to sell you something. This is a chart of soybeans. And as you can see, there's let's call it 4 segments to this. There is the early congestion running into 2020, the uptrend of 2021, market then drifts back. And then come this year, market takes off again. What I did was I went and looked at the bull markets that we've had in soybeans dating back to 1979, 1980. You'll notice there are 2 colours displayed here. The yellow are the best 2 moves. You'll notice the best move in terms of percentage moves occurred in 06 to 08, about 180% move. Took 518 days. Next best, 95. The current segment of moves, which are highlighted in green down the bottom, are 82% and 34.8%. Now, there's an important thing to note about this. I've used monthly closing data. So this uses the closing data for the current period back to March. So it would look slightly different if I'd use weekly data, but for the current market move, it only adds a few percentage points. It doesn't change materially from what we are seeing. This puts the current move in context because one of the things we need to do with commodities moves is to put them into context. History counts. Not what you saw today counts, but what has happened every other day before we got today counts. And the reason for that will become apparent in a second. If we look at soybeans monthly, we can see that particular move of 0608 and our particular move now. And they are two standout moves. Prior to that, you'll see that for the past 3, almost 4 decades, soy had a history of having an upper limit, a point beyond which traders were unwilling or unable to push price. But I want to come back briefly while I've got this chart open to look at the difference between an equity chart and a commodities chart in terms of the unbridled nature of speculism, and talk about why that speculation is different. This is LKR, and you will see starting from 2021 it's had an order of magnitude rise, which is an extraordinary rise. So again, we go back to right time, right place, right market. This is a function of being in the right market at the right time. But there's something interesting about this. If I had bought this stock at 10 cents, that makes no material difference to the company at all. If I bought the stock at $2.50, that makes no material difference to the company at all. The only impact this has upon the company is that if executives have executive options expiring at various dates, at various strike prices, when this sort of price run is occurring, it makes them very rich very quickly. So they're very happy. But in terms of what this company does, in terms of digging stuff out of the ground, it has no impact. It doesn't matter. That's a different situation with commodities. And this is why history counts, and understanding how these things function count. What I've done here is I've bracketed the 2 points at which price seemed to struggle. You have to ask yourself the question why, for those previous 3-4 decades, price struggled. Consider the structure of commodities markets. Commodities markets are made up of a series of market participants. They're made up of speculators, who are people who are just trading for profit, and they provide a valuable service in the market because they generate liquidity and price discovery. Counterparty to that are hedgers and producers. These are people who actually grow these crops. So the price of the instrument matters to the people involved in production of the item. And it matters to them for a simple reason. There comes a point when the economic utility of end users buying soybeans becomes prohibitively expensive and they stop. I'll give you a simple anecdote. Before recording this, I was out at lunch at my favourite Greek restaurant. I was chatting to the owner. And I have the same thing when I go there all the time, being a creature of habit. I have the lamb skewers. And we were talking about the price of lamb. And they were saying that the price is becoming extraordinarily high. And it makes it very difficult for them because they cannot pass that price increase on to consumers. So I said, what will you do? And she said, it's simple. We'll stop offering that dish. There is an economic endpoint to commodities markets. But there is a secondary point to this, and that is that users of these markets are sophisticated. So if they see that a given commodity is moving, they will plant more of that commodity. So you run into 2 points. You run into a point at which demand slackens off because it's simply become too expensive for the end user, coupled and married to the notion that we now have increasing supply. So demand drops off, supply increases. What happens then is price falls. It's a natural cycle. And if you look at all, I won't say all commodities, but if you look at the agricultural commodities as a group, you see this sort of cyclical behaviour. It's not perfectly predictable, like a lot of idiots will say, but it is a very, very broad cycle. And as a trader, you actually need to be aware of that. You cannot operate in isolation of this because you will get caught by that. You'll be the peanut who buys soybeans at $17.50 and wonders why they haven't gone to 17,500, because that's what happens with shares. But these are not shares, these are commodities. They're very, very different. And this is one of the quirks that people fail to understand. So if you are a commodities trader, my advice to you is open up a chart, convert it to a monthly time frame, and simply have a look at what happens. I understand that the majority of traders think that if they're looking at daily data, the only data that matters is that week's worth of data, because the market didn't apparently exist before they started looking at it a week ago. Unfortunately for them, it did. So what are the take-home messages from this? Well, history is important. What happens today needs to be viewed into context of what has happened in the past. But this history is not set in stone. Unfortunately, many, particularly technical analysts, take this and they believe that that markets are clockwork, they're Newtonian, and they're not. And in many, many ways, this sort of technical analyst shares the same foibles that economists do. Economists believe that human beings are rational, and they will not let that argument go, despite all evidence to the contrary. Technical analysts believe that in many ways markets are rational because markets and the people in them will see these magic price points and then act accordingly. And it always happens to be that they will act accordingly to whatever their prediction is. It never works out that way. So history is important, but it's not set in stone. It's very, very fluid. Be cognizant of it, but don't become wedded to it as a matter of ego. The third point is prices will move further than you could ever imagine. And this catches everybody, because everybody believes that they have an intrinsic ability to understand what the worth of something is or how far it should go. But again, we're back to that old adage that the only opinion that matters is the markets. And so as a final point, I would simply ask the question, what happens when your opinion is at odds with the market's reality?